Welcome to our channel where we break down complex financial concepts into simple, actionable insights. Today, we're delving into tax amortization benefits and how they can be leveraged to optimize your financial strategy. First off, what exactly is tax amortization? Simply put, it's a tax deduction that allows you to spread the cost of an intangible asset over its useful life. This could apply to things like patents, trademarks, or even goodwill from an acquisition. Imagine you purchase a patent for $100,000 with a useful life of 10 years. Instead of deducting the entire $100,000 from your taxable income in the first year, you get to deduct $10,000 each year over the next decade. So, why is this beneficial? Tax amortization helps smooth out your tax obligations over multiple years, instead of hitting you all at once. This means more predictable financial planning and improved cash flow management. Now let's dive deeper with some real-world examples. Consider Company A and Company B. Both spend $100,000 on different intangible assets with the same useful life of 10 years. However, Company A uses tax amortization while Company B does not. As you can see, Company B takes a massive deduction in year 1 and none thereafter. This could result in a high taxable income in subsequent years, impacting cash flow. Now, compare this to Company A, which uses tax amortization. Company A's deductions are evenly spread out over the 10 years, making for more consistent financial planning and reduced tax burden annually. Let's pose a question. What if the useful life of the asset changes? Suppose the patent in our example has a modified useful life of 5 years instead of 10. In this case, the annual deduction would increase, but the principal remains the same. Using the equation we discussed earlier, for Company A, the new graph would show consistent annual deductions of $20,000 over 5 years. Even with this change, tax amortization still provides the benefit of smooth, predictable deductions. Now, let's address some common questions about tax amortization benefits. Question 1. Can all intangible assets be amortized? The answer is no. Only certain intangible assets qualify for tax amortization. Generally, these include purchased goodwill, patents, copyrights, trademarks, and some business startup costs. It's important to consult with a tax professional to understand which of your assets qualify. Question 2. How do you determine the useful life of an intangible asset? Determining the useful life involves assessing factors like the asset's expected economic benefit, legal or contractual life, and industry standards. Some assets, like patents, may have a clearly defined useful life, while others may require more judgment. Lastly, how does tax amortization impact financial statements? Tax amortization affects both the income statement and the balance sheet. Amortization expense reduces taxable income on the income statement, while accumulated amortization is recorded as a contra asset on the balance sheet, reducing the book value of the intangible asset. To summarize, tax amortization can provide significant benefits for businesses with intangible assets, including smoother cash flow and more predictable financial planning. By spreading deductions over the asset's useful life, companies can better manage their tax liabilities. Thank you for joining us today. If you found this video helpful, please like and subscribe for more finance tutorials. And don't forget to hit the bell icon to stay updated on our latest content.